All right. Good evening, everyone, and welcome to our webinar series. Thank you for taking the time out of your busy schedule to join us today. We are thrilled to have you here and hope that this will be an excellent opportunity for everyone to learn. I am Anchal Dwivedi, Managing Partner at Goldstone Capital Ventures, and I'm joined by my fellow managing partners, Dinesh Nayak and Shruti Dwivedi, as well as our guest speaker, Lauren Jacobs. We are very excited to introduce Goldstone Capital Ventures, a company that specializes in identifying and acquiring underperforming assets with potential for significant value-add opportunities, specifically in multifamily sector. Our experienced team has proven track record of transforming these properties into thriving communities. We have acquired over 11 apartment buildings, totaling more than 1,100 units across Carolinas, Texas, and Florida, working on properties in Tennessee and Wisconsin now. One notable acquisition is a new construction of 184 luxury apartments in Winston-Salem, North Carolina, which is currently in a development stage and set to become one of our premier luxury apartment communities in the area. In addition to our focus on value add and new construction deals, we are excited to announce upcoming projects in the assisted living and student housing sectors. We look forward to sharing our expertise with you today. And here's our contact. If you see it on the screen, you can take out your phone and scan this barcode to log into our cash flow portal, syndication portal, where you can see our current deals, and also you'll get notification about our future deals. This is the little disclaimer that says this webinar is only for information purpose and it's not a legal or investment advice. Please read through it. These are some of our acquisition from last 1.5 years. This is Ivywood Apartments, 96 units in Gaffney, South Carolina. This is recently acquired in 2022. This is Suite Redemption, 44 units, short-term rental in Arlington, Texas. It's right across the Cowboy Stadium. This one is Shaftwoods, 40 townhouses in Charleston, South Carolina. Just closed this year in 2023 recently. Cheslin Place, 98 townhomes in Spartanburg, South Carolina. This is the asset that we closed in December of 2022. And this is One Salem luxury apartment. This is a new construction project, 184 units in development stage in Winston-Salem. That's coming up. And then 252 beds student housing, Nashville, MSA. This is one of our current deal in student housing sector. From here on, I'll pass it on to Dinesh to talk about this one a little brief.
Yeah, thanks, Anchal. Good evening, everyone. Welcome. I'm really happy you guys are taking time from your previous, precious evening, especially spring. Beautiful weather outside, and really thank you very much for being here. So we have a new investment opportunity. This is in just outside Nashville. This is a student housing opportunity. This is a 2016 built student housing, 252 bed. If you can scan that QR code, and that will take you to the portal, and there you'll get all the information about this. So I won't take much time on this, but it's a great opportunity because the property is already leased up for 23-24 school year, 100% leased up already, and we have already gone over the pro forma rents. So, and there is no capex involved because it's totally new building, 2016, and yeah, the value add play is basically increasing the rents. Lot of spacious rooms, spacious units, even the fitness center on site within the building itself. With that, I will pass it on to Shruti. She will introduce Lauren. Lauren has been our friend for a long time, and we are already, doing business with him. And Shruti will take it over from here.
Okay, thank you, Dinesh. And good evening, everyone. Thank you for joining us tonight, and we are really excited. So I would like to now welcome Lauren Jacobs from Arrows Capital Group. So Lauren and we have been partners on a couple of projects already, and we are planning to grow together in years to come. Lauren has spent his last 9 years gaining experiences in commercial real estate, including new development, multifamily, and senior living investments. Since co-founding Arrows Capital Group, Lauren has shown his ability to create value across portfolios. He currently has an equity interest in over 674 commercial real estate units, totaling $85 million in assets under management. His strengths include project analysis, commercial real estate acquisitions, asset operations, and value creation strategies. As a proud father of 2 and a loving husband, Lauren believes that his personal commitments to his family have strengthened his professional abilities. So without any delays, let's jump into the meat of today's conversation. But before I pass the ball to Lauren, I just wanted to call that if anyone come across any questions during this presentation, please feel free to put your questions in the Q&A box, and we will be going over the Q&A at the end. Okay, stage is yours, Lauren.
Awesome. Thank you, guys. Thank you very much. As Shruti had mentioned, I've had the pleasure of working with Goldstone and these wonderful folks before, and I'm excited to do so again. So thank you guys for having me. Very excited to be here. I am going to make this a little interactive, so you don't have to just listen to me ramble for the next however many minutes. So I'm going to ask some questions as we go along, and would love to have some people jump in, participate, and answer. To tell you a little bit more about myself and my background, I'm actually a 5th generation real estate investor. So real estate, lending, property management has been in my blood for several generations. So it really just came into it very naturally. Over the past several years, really been asking, how do we make an outsized impact on the world, on society, on people, right? So we're really focused, and ultimately why we landed in the multifamily space and commercial real estate, specifically multifamily and senior living, is that we have such a direct ability to impact people's lives and bring a positive influence to their communities, their homes, where they lay their head down every night. So we're firm believers that you can pair investment capital with social impact for a return while positively affecting and impacting the people of those communities. Along the journey, I had been told by a mentor very early on to do 2 things: to network, to become a professional networker, and to get really good at underwriting and analyzing opportunities. So I did my best to do those 2 things, and I've spent a ton of time learning about underwriting. I've been underwriting commercial real estate for years, and I've seen a lot change over the past several years. And I think now is as important of a time as ever to reflect on some of those changes and to perhaps use that as a guide to help us ensure that we're doing our best diligence on underwriting and analyzing future opportunities, because the market is changing, and it's changing quickly if you're paying attention. So for starters, I wanted to talk about some of the metrics and things that we'll see as investors and as other people will present for the deals that they're talking about. Commonly, we're going to see returns. Everyone's going to offer returns, and the rates of returns are really can be adjusted based on the risk or the asset class of the deal. Some of the common returns that we're going to see are things like cash on cash returns, AAR, IRR, equity multiple. So I get the question a lot, what do those mean? What do those metrics mean? If you haven't been diving in real estate, commercial real estate and investments, those may not be very intuitive terms. So I just thought I would rush through those quick. So, there's a common understanding of what we're looking at when we're looking at some of these deals and offerings and underwriting, which ultimately lead to a set of returns. Cash on cash. What is cash on cash? Cash on cash is the annual cash flow that I receive from an investment divided by the cash that I have invested into the deal. For easy math, let's say that I make a $100,000 investment into this awesome opportunity we just looked at from, that Dinesh just presented. If I receive $6,000 a year in distributions, let's say, $6,000 divided into $100,000, the cash I received annually divided into the cash that I invested is my cash on cash return. That would be a 6% cash on cash return, which in today's market is pretty good. 6% plus cash on cash, 7%, 8% plus cash on cash. Those are, that's good cash flow in today's market in these changing times, which may be different from deals if we looked at deals 3 or 4 years ago, but it's a totally different market, right? AAR, what is AAR? Average annual return. Again, this is a relatively simple metric as well. It's simply the total return that I've seen across the whole investment divided by the number of years that I was invested in that opportunity. So I invested $100,000. I got a total of $200,000 back over, so I have a $100,000 gain divided by the 5 years that I was invested in that deal. That's a 20% AAR. IRR, this one's a little more complicated and complex of a return. I don't love to use IRR a lot. This is more of a finance, institutional level metric, but a lot of people do understand and like to use IRR. IRR is internal rate of return, and really that probably the simplest way to try and define IRR, is the rate at which the net present value of cash flows from an investment equals 0. That's not super intuitive if you're not familiar with finance, but really what that means, it's just one more metric to size up an investment opportunity and see how it's performing. If IRR is greater than the cost of your capital, then that is seen to be a cash flowing or a positive return investment. Of course, the higher the IRR, the better the investment, or the better the return, I should say. So equity multiple is, again, very similar to AAR, average annual return. It's basically what is a multiple of your invested capital. Lots of times you might see 2x multiple. Well, you can expect to earn 2 times the amount of equity that you invested into the deal initially. Moving beyond some of those basic returns, what are some key elements of a deal to look at when you are analyzing a deal, especially in today's market? I simplify this down into 3 things. There are 3 things that I look at when I'm looking at any deal in order of priority and importance, in my opinion. Number 1 are the people. Who are the people? What are their experience? Is their proximity to the deal or the opportunity? What is their experience in executing this type of business plan? Do I know, like, and trust these people? Do I get an eerie gut feeling when I talk to them, or do I get and feel warm and fuzzy? While that's not a very objective way to measure a sponsor team, it's meaningful. Our intuition is strong, and don't take that for granted. So some questions that you can ask are, how long have you been doing this? Some of the things that you heard Anshul talk about a little bit earlier: number of doors or number of deals that someone has experience in. What are some mistakes you've made in the past? Have you lived through these types of market conditions or operated in economic turmoil before? Have you been through previous economic cycles? Have you gone full cycle on an opportunity? Lots of questions you can ask to gauge the level of experience and credibility that should be allocated to a sponsor team. And that's the most important thing. You can have a below average deal that is made into a good deal by an excellent sponsor team. And conversely, you can have an excellent deal that falls apart because of the wrong people at the helm. Secondly, I look at the market. This, again, is very, very important. A great market can make a deal, and the wrong area can break a deal. So be very careful when you're looking at opportunities and sizing up the market, and not only the macro market, the sub-market, the neighborhood, the immediate adjacent properties are all very important when we're looking at a deal. And this is part of the underwriting and the analysis process, is assessing and analyzing the sponsor, the people, analyzing the market, and ultimately, third and final, would be analyzing the deal. Again, I value and prioritize analyzing opportunities in that order of importance. What are some of the questions that we can ask about a market and a deal? In the market, what is the median income of the area? Is it really low? Does the business plan align with this type of market? What are some of the nearby amenities? You'll tell a lot by, do you have a 7-Eleven down the road, or do you have a discount tobacco, or do you have a Starbucks and Whole Foods across the street? Very big difference between the neighborhood that you're investing in. Does the business plan align with this market and sub-market that someone is that the property is located in, right? And finally, the deal itself. The deal itself gets really exciting because there are a lot of levers that can be pulled. There's a lot of ways to analyze a deal, and it's a bit of an art and a science. So we can objectively look at numbers and returns, but there's a lot of subjectivity and abstract components to underwriting and modeling an opportunity, which are the pro forma. Not only are we analyzing historical data, but we are also modeling out what we anticipate the future performance to be. And that we can use a lot of empirical data to substantiate our assumptions with rent comparables, with historical performance, with what is that property across the street doing, where are their rents, and why I think I can follow or achieve different results than they have. A couple of things that are really important to consider when we're looking at a deal are understanding the business plan, understanding how do the people plan on going from A to B. Okay, we plan on achieving a return, which is why people are interested in investing into an opportunity, which means that there must be cash flow and we assume that we're going to sell this asset, this investment, for a higher price at a future date. Why? How are you going to add that value? Understanding that is crucial, and asking questions and poking holes in how that may or may not happen. We're entering an era where this business plan is more important than ever, where high degree of operational execution is paramount. In days gone by, operators have been able to get out of an average deal with great returns because the market, they rode the wave of the bull market, right? We're all a genius in the bull market. What does the future hold? And that's something I think is important to talk about, and I can touch on a little later. Current market conditions and where they may be going. But the days of 18%, 20+% year-over-year rent growth are days gone by. So it'll be very important that the operators execute very effectively moving forward, which makes it even more important that we as investors are asking the right questions and analyzing the deals effectively on the front end to mitigate our risk. What are some questions that we can ask? Well, what are the assumptions driving the projections, especially the income projections? This is where, from underwriting a lot of deals myself and laying eyes on a lot of other underwritings, this is where I most commonly will see, maybe a mistake isn't the right word, but aggressive underwriting assumptions would be in the income escalation and the projections as far as income and rent growth. That's a place where I would ask a lot of questions. Here's the T12. A T12 is a trailing 12-month profit and loss statement, right? So here are the historical financials. Here's what the property's done over the last year. And here's your year one projected pro forma. How do you plan on going from A to B? What are you going to do to increase income by X amount? What is that percent change year over year? How is that going to happen? That's a huge question. And that's a place where I see people get aggressive. So definitely something to keep an eye on. Another big area that I like to look at are the debt assumptions. What kind of debt is in place? What kind of debt is projected to be in place on this investment opportunity? Is it fixed rate, long-term, permanent debt? Great. That's pretty safe. We know what to expect, and there won't be a lot of variability over the next several years unless we have an interest-only period. But we know, that's a known length of time, and we know what that future principal and interest liability will be in the future. Or is this bridge debt, which oftentimes you see with value add opportunities? There's a bridge opportunity to, there's a lender who will be willing to bridge the gap while you stabilize the property and perform your improvements to add the value until you can refinance into a permanent debt structure. That's a very common way, but it's also a way that in days gone by, people have been undisciplined at times. Not everybody, but some have made undisciplined acquisitions. And if you're paying attention, you're starting to see some of that in the market. Some of that is already turning over, going into receivership, going into foreclosure, and that is something to keep an eye on. So all the more reason it's really important to pay attention to the debt assumptions. Bridge debt is okay if structured correctly, and we just need to make sure that it's structured in a safe and responsible manner. Is it a fixed rate bridge? Okay, well, we're not at risk of that variability of that interest rate. Is it a variable interest rate loan? That's more risky. I have some more questions to ask. When do you plan to refinance out of that variable rate debt? Do you have a rate cap in place? And what is the spread? What index is that variability based on? Some indices are more volatile than others. So that's a question where you can start to get into some more risk. And I mean, imagine the folks who got into bridge debt 12, 18 months ago, and now, rates are in, some instances, over 450 basis points higher than they were at that time. So, your variable rate bridge loan, just the interest only component of that could be 2.5x what it was 18 months ago, which is pretty wild to think about, and in some cases more. So that's obviously can be very risky, because most people would not have projected that or anticipated that in their underwriting. So really important to ask about the debt assumptions. Is there a refinance involved in the underwriting? What happens if we eliminate the refi? What do the returns look like without a refinance? There were a lot of some people underwriting deals 2 years ago, right? Many of those folks underwrote a refinance into their model and into their business plan, which makes a ton of sense because it's a great way to decrease risk for investors by pulling some cash out, returning some of that equity investment, and thus increasing returns. Who do you think 2 years ago was underwriting a refi with 7.5% interest rate, 6.5% interest rate? Not very many people when they were underwriting a 3% interest rate 2 years ago, right? So it's a bit of a shot in the dark. So again, I just ask, is the sponsor underwriting a refi? If so, what are the refi assumptions? What happens if we eliminate that, or if you're unable to refinance into the future? One other thing that's important to ask, and that we implement in all of our underwriting, are sensitivity analyses. We do the best we can to plug the correct numbers in, to use data to drive our decisions, to make our modeling and underwriting as unbiased as possible, right? But I assure you, whatever numbers are in the model are not going to play out exactly. Oftentimes they play out pretty close, which is great. Sometimes they don't. So what we implement, and what a lot of sponsors implement, are different sensitivity analyses to understand the potential risks if a metric or a component of the deal goes sideways one way or another, and a little bit or a lot. And it's important as an investor to understand those sensitivity analyses, what they are, and ask for them or about them, or if they've even been considered. A few different sensitivity analyses that we always look at and we always run would, number one would be a break-even occupancy sensitivity analysis. At what point does this deal break even? Dinesh just mentioned the student housing deal in Nashville is 100% occupied for the 23-24 school year. That's amazing. That's just truly tremendous. But at what point would it break even? 70%, 65%, 75%, somewhere in there, I would imagine. That tells you, again, how risk averse is the opportunity, or how risky is the opportunity, right? Another way to look at that would be your debt service coverage ratio. It is really a different way to look at that. And what that is, that's a metric that lenders will look at to analyze how much buffer room is there in your ability to service your debt, right? So how much income are you projected to make above your operating expense and debt service obligations? So what we look for, and again, this depends on the asset class. Student housing will be different than multifamily, which will be different from senior housing, right? So it's important to give context to the asset class that we're looking at. 70% break-even occupancy in multifamily is really strong. So anything that's at that 70% or lower break-even occupancy, that's a really strong opportunity. So that is one sensitivity analysis that we look at. Another one would be cap rate sensitivity analysis, specifically exit cap rate. So whenever we underwrite and analyze a deal and we land on returns that are being projected, we talked about the returns earlier, we need to assume what an exit looks like. What does a sale look like? And in order to do that with commercial real estate, we drive value from a cap rate. So what is the exit cap rate that is being used to drive the exit value assumption? Great question. And an even better question is why? Why have you chosen that cap rate? How does it compare to the market cap today or your entry cap rate? And you can perform a sensitivity analysis on that exit cap rate assumption. Well, what happens if I'm using a 5 cap as my exit cap? The market is at a 4.5 cap today. I'm projecting an exit at a 5 cap. That sounds reasonable. That sounds conservative. We've added, maybe 10 basis points over a 5-year hold, 50 basis points total as a cap rate reversion. But what happens if we actually sell at a 5.5 cap or a 6 cap or a 6.5 cap? When does it become not a good deal, right? That's pretty drastic cap rate expansion, but that is another sensitivity analysis we can look at. If the market today is a 4.5 cap and we have to sell at a 4.5 cap in order for this to be a deal, that's there is no leeway there. There is not much room for error. That would be a riskier deal than, saying, hey, we can sell this at a 4.5 cap and it'll be an excellent deal. We can also sell this deal at a 5.5 cap and it'll still be a really good deal. So there's more buffer there. That deal has less risk and again, would be a stronger option from a risk aversion standpoint. Operating expenses. So operating expenses can be a little tricky, and they can change, especially in today's market. They can fluctuate pretty drastically, given the high rates of inflation, especially in where there's any staffing involved, turnover, payroll increases to keep folks on board. Taxes and insurance, depending on the areas you were in, are changing and increasing pretty drastically. So what happens if we've undershot our operating expense budget? What happens if operating expenses are actually 10% over? Is this still an opportunity? Similar strategy to what we did with the break-even occupancy, but now we're doing it with the expenses as opposed to the income, right? Just straining the deal until it doesn't work. And how much buffer do we have? The bottom line is with these sensitivity analyses, the more buffer that we have in order for this to be a deal, preserve capital and give a return, the stronger and more risk averse the opportunity. One of the last sensitivity analyses we look at are what if income remains flat? What if income doesn't grow? What if it doesn't even grow at a moderate or marginal rate? Or we've heard some folks doing some sensitivity analyses recently of what if rent actually declines? Can the investment opportunity withstand a reduction in income or rent and still perform? So again, those are being a little, those are some aggressive sensitivity analyses, but they're important to understand a full scope of possible outcomes and how resistant this opportunity is to things not going exactly the way that we project, which is oftentimes the reality. Any questions over any of that so far? Any questions?
We do have one question, Lauren.
Please.
Someone's asking, how do you calculate cap rates? Please give some examples.
Oh, okay. Awesome question. This is a bit of an abstract question, and I'll give you my honest answer. My honest answer is that a cap rate, a capitalization rate, is an outdated metric that really shouldn't bear as much importance in today's markets as it does. My opinion, my honest opinion. Why is that? Well, a capitalization rate is would be your return on investment if this was an all cash transaction, right? But who purchases large commercial real estate with all cash these days? Maybe there are some, I'm sure there's somebody out there, but it is not the best use of capital, right? We can go borrow capital at a fraction of what it's worth in increasing our returns. Granted, I guess the counter argument could be that, yeah, that adds risk because the lender is going to go strap a lien on the property, and if anything happens, they have the ability to put you in foreclosure or receivership. Anyways, I digress. Cap rates are used today, even though we don't typically transact with all cash purchases. The way a cap rate is determined is, let's say that we are looking at 200 unit student housing in Nashville, and we want to determine what is a fair value for this property. Well, we're going to go look at what is the market cap rate in this area, and the broker or a set of brokers in the market are going to go look at all the comparable sales in the area. How many other 200-ish unit student housing communities have been sold in the past 6 months, and in the closest proximity as possible? The closest comparables are going to be used, and then they're going to say, okay, here was the cap rate of that transaction. Here's the cap rate of that transaction, and that one, and they're going to be averaged together, and ultimately they're going to create a market cap rate, a given market cap. So that's, again, somewhat subjective, because your opinion and my opinion of how comparable this property and that property are may be a little different, but also it can be very objective, because cap rates are very objective to calculate. It's math, right? It is what it is. And we can average those numbers and create a market cap in that area. And then there are variances within an opportunity. Is this opportunity more occupied or less occupied? Is it newer? Is it older? Does it require some physical renovations? Does it not? And then you can adjust, what you think a fair entry cap is based on some of those factors. That was a lot and a little all over the place. Did that adequately answer your question?
Thank you, Lauren. Anything, Anshul and Dinesh, you want to add to that?
Yeah, this is a great explanation. And also, I mean, the cap rates are there to compare various type of assets also, right? So in the same location, when brokers are doing this analysis and finding out, what type of asset has what cap rate, so we can actually compare multifamily with hotel, with assisted living, and all of them will have variable cap rates. So that's another way to compare various assets and which will give better returns. The higher the cap rate is, the higher the risk. We have one more question here from Gops. With this high interest borrowing rates and all major impact on commercial properties, what impact will it have on rate of return and potential loss from potential recession that is in the process?
Yeah, a really, really good question. And, I would argue that we're beyond a potential recession, and by most definitions are and have been in a recession. So awesome question, and really exactly what I wanted to end on, which is what is the future outlook of the capital markets in the space. You have, like we talked about earlier, there is a lot of debt out there right now. I've read a few different pieces of information, but they're somewhere between well over $50 billion worth of debt that needs to be refinanced in the next 6 months. $200 billion worth of commercial real estate debt that needs to be, is maturing in the next 2 years. I read about an underwater portfolio in New York City of office space that was a $56 billion portfolio of office space in New York. Loan is maturing in the very near future, and lots of unrealized losses on the books because their occupancy 24, 36 months ago, 60 months ago, when they secured this loan, was in the 90s, and now is in the 60s. So again, great question. How do these market conditions affect returns? Well, we're in a phase that lenders often refer to as price discovery. So if you hear that term, your ears should perk up a little bit. And really what it means is that we're in the middle of some market turmoil. There's some changes, and lenders, buyers, investors are just unsure of how to react. We're not on stable ground, right? So more granularly, what that means is 2 years ago, buyers were buying here and sellers were selling here, and that just kept pushing up and up and up. We're in a very heated, saturated market, and still are to some degree. In the interim, rates have skyrocketed at an astronomical rate. And what that has done is that has decreased buyers' buying power. Sellers' expectations are still here where they were 12 or 24 months ago in a lot of cases. But buyers are saying, hey, we can't buy there, and lenders won't lend up there. Lenders are getting tight. Well, I don't think we have time to go down the whole rabbit trail of the credit crisis. But we're certainly not out of a credit crisis. Almost three. Two of the three largest bank collapses have happened in the last 60 days, 75 days. Almost a third, but they recently got acquired by JP Morgan to save the day again. So credit is tightening. Credit is getting really tight, and that's twofold. That's one, making it harder for buyers to buy. So selling prices are going to have to adapt. Sellers will have to adapt in the near future because buyers are being forced to adapt. And what is that doing for returns? Well, on one hand, you can look at it in a sense of, well, I might be able to get a better deal on opportunities in days ahead, but your cash flow, you've seen cash flow get so constrained. Yield, people are chasing yield at an all-time high because it's so hard to find right now with rates so high, and seller expectations that's the price discovery phase. The seller expectations have not trickled down to an appropriate place yet, which is why you're seeing low transaction rates. Deals are being transacted and they're happening, and good deals are always out there. Don't get me wrong. Cash flow and yield is harder to find. So to really answer the question, that's part of the answer, is that cash flow is harder to find. Interest rates don't necessarily affect NOI, right? Interest, principal and interest falls below the line. So it's not directly affecting values, but what is affecting values and why were the interest rates cranked up in the first place? Because inflation is running amok. Without rewinding too far back into why that happened, inflation is high, and so that's driving operating expenses high, and we're seeing year over year rents decline. So we're seeing expenses go up, we're seeing rent increases decline, and there's going to be a crossroads where all of a sudden, do we get to a point with certain assets where operating expenses are increasing at a higher rate than income is? So now it is affecting NOI. Now we're compressing our NOI margin, and we're actually losing value. That's a possible phenomenon and something to consider in the future. So those are really some things to be cognizant of, how these macroeconomic conditions are affecting this industry, commercial real estate as a whole, and specifically down to an investment level and return level. All the more reason to ask the right questions, to analyze deals effectively, diligently, and to really ensure that you're assessing the sponsor, the market, and the deal properly. So there are strong operators out there. There are great deals out there. But now more than ever is certainly a time to spend your time on your due diligence.
Yeah, and most of these the deals that are suffering are office spaces and retail spaces.
Yeah.
So,
yep.
Yeah, especially within the commercial space. Multifamily, I believe it will do just fine because everybody needs a roof on their head. So
yeah, there will be some hurt with the deals where that kind of that irresponsible, or maybe a better word is anyways, we'll stick with the irresponsible. The debt is put in place, that bridge loan, high interest rate, variable interest rate debt without rate caps or anything. There will be some hurt in that space.
Yeah.
Some of the ways, sorry, real quick, I'm sorry to go over, but one more thing I want to add. A great question to ask to assess I guess some of the things that are being done to avert risk within a deal. A couple things that we do. One, like cash flow. Find the yield, find the cash flow. Strong cash flow doesn't eliminate, but it mitigates a lot of risk. Number two would be adequate cash reserves. How much cash reserves are being underwritten in the deal and being raised for the opportunity. Adequate cash reserves. I mean, you run into two issues when you run out of capital. That's a dangerous spot to be in. So what are the cash reserves, and why have you picked that number? And number three is the maturity risk. And we talked about that a little bit earlier with the debt assumptions. But typically those bridge loans have like really tight maturity windows, 2, maybe 3 years. Or do you have 5 years? Do you have 7 years? Do you have 10-year maturity window? Right? The tighter that maturity window, the quicker you could be forced into a less than ideal exit because you don't have any other option. Exiting in the midst of market turmoil is less than ideal. So
there's another question from Celine. How many basis points do you use for the exit cap rate? It used to be 10 basis points.
It used to be 10 basis points per year of hold was the gold standard. That's a good question. is really that I would just lump that into more of a sensitivity analysis instead of like there's really not one answer. How conservative do you want to be, or how aggressive do you want to be in your assumptions? And I look at all of it. So what happens if cap rate reversion of 20 basis points a year, 25 bips a year? That's a extremely conservative basis for a sensitivity analysis. But it's good to understand that's possible, and also understand the deal, the market you're in. C-class workforce housing in the secondary or tertiary market is a deal that may be more likely to see some of that volatility, as opposed to a B-class or A-class newer build, right? It just depends too. And that, sorry, I'm going down another rabbit hole. Another thing to look at is how many units are coming online. There's a ton of units being delivered right now, and disproportionately in certain markets. I think I read, anyways, Dallas, Fort Worth, great market, tremendous market, awesome market, but just a record amount of new deliveries. And, now all of a sudden you're going to be competing with those new deliveries. And, just one more question to ask when you're analyzing risk of an opportunity. If you're looking over here and this deal has no planned new comparable deliveries in the next 24 months, and this deal over here has 20,000 new deliveries projected in the next 6 months in its proximity, that's one more factor to consider when assessing risk within an opportunity. Sorry, I totally got sidetracked there.
Yeah, in continuation of that, anonymous attendee asking, can you explain basis point?
Oh, sorry. Yes. A basis point is 1/100th of a percent, right? So when we're talking about 100 bips, 100 basis points is 1% when we're talking about a rate, an interest rate, a cap rate. Sorry, that's just some like finance lingo.
Yeah.
Okay,
Alright.
you already covered this in continuation of impact on recession, and also the issues with what local banks are facing currently.
Local banks, yeah, absolutely. The FDIC in Q4 2022 identified 300 domestic banks as insolvent. We've heard about 2 of them, maybe 3. You've heard about 3 of them. There are over 297 more that more than 6 months ago were declared insolvent by the FDIC and flagged as a risk. So yes, these, to make a very long and complex story very short, a lot of these small and mid-sized banks carry bonds, T-bills, U.S. federal treasury bonds on their balance sheets. And when rates go up, the value of that bond portfolio goes down. So a lot of these small and mid-sized banks are holding these assets, these bonds that have declined significantly, and sometimes in some cases by 50% or more in value. There's a secondary bond trading market where these institutions can liquidate those bonds when they need liquidity to fund depositors their deposits. Well, they can't do that when they've lost 50% of the value in someone else's deposit. That's the liquidity crisis that's going on in very short. And so yes, it is in my opinion, a very real issue and not talked about enough and far from over.
All right, I think we are close to the top of the hour. Yeah, it's already 9 o'clock here. I think we can wrap up. What we see is, as Lauren said, you have to ask the right questions. You have to look at the right markets, and local market is very important. And the other thing is, if any deal works fine, if any deal cash flows now, I think it might cash flow really well in the future. The other thing, and also in student housing, especially the deal we have in Nashville, we are assuming a 4.38% fixed rate from the previous the seller. So that's a loan assumption for 6 years.
Yeah, that's awesome.
Yeah, that's a fixed rate. So there are a lot of opportunities coming up in the next couple of years. I think it will be a really exciting scene to be. Yeah, if we can survive a couple of years, and
Oh yeah.
even in multifamily or senior living, student housing, there are a lot of opportunities coming up.
A ton of exciting opportunities. There was a question in here about COVID, and COVID over the past couple of years has beat up a lot of owners across commercial real estate, even in multifamily, with the moratoriums and student housing and senior living. There are a lot of just tired and fried owners that are ready to exit and to move on. And for those with experience who have the ability and the wherewithal to structure safe, strong deals, there's a ton of opportunity out there. Don't get me wrong. It just also a time to just be very ask the right questions and ensure you're investing with the right people for the right reasons. So, absolutely.
All right. So do you want to wrap up?
Yeah, sure. I think, thank you so much, Lauren, for your time today and answering all the questions. I hope this session has been very helpful for all the attendees. And if you have more questions which you didn't get a chance to ask here, feel free to send us, those questions. You guys have our contact information, and we would be happy to get back to you. But having said that, thank you all so much for giving your time tonight and joining us. Good night.
Yeah, thanks everyone. Thanks, Lauren.
Thank you guys so much for having me. I
A
appreciate
lot of information.
All right. Yeah, it's always great listening to you. And
sorry, I hope that was helpful. So
it was great. It was a great session. Yeah, very, very informative.
I really do. I love the space and I enjoy it. So I love talking about it. And as you can tell, sometimes I just get talking and don't stop. But thank you guys so much. Really, really appreciate the opportunity. And I look forward to talking soon. Have an awesome night.
Sure, absolutely.
Awesome.
Good night.
Thank you so much. Bye-bye.